Hey everyone, welcome back to another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform, M1 Finance. And we've been hovering around the $58,000 to $60,000 mark for a while now. We had a bit of a market pullback thanks to all the negative news around China and the Evergrande situation, which really isn't much better now, but the market seems to have forgotten about it. So it's recovered a lot of what it's lost in the last couple of weeks. So I guess no complaints there. I'll take it, but I am investing for the long term in any event. So what happens in the short term generally just means that there's more opportunities to invest because of the volatility we see in the short term, where you might have the opportunity to buy a company at a really attractive price based on what you value it. That's kind of your classic value investing approach, where you value the business independently and then see if the price is attractive based on that value. And if you guys want to see my exact portfolio and want to look at all the individual holdings, you can actually go down to the description below, where I always include a link to that episode's version of the portfolio. If you have an M1 Finance account, I am an affiliate and you can sign up using my affiliate link in the description below. That would also be great. But if you do have an M1 Finance account, you can actually copy this portfolio straight into yours. It's not financial advice by any means, but maybe you like some elements of this portfolio. You can actually just copy it right in. You can edit it as you see fit based on your own preferences. And it's a nice little tool to get a quick start to your portfolio. I find that M1 Finance is one of the easiest brokerages to use, especially for long-term investors. It doesn't have a lot of capabilities when it comes to shorter-term trading, since you have like trade windows that you have to trade in, and they don't offer options and all that sort of stuff that you might find on something like a Robinhood or many of the bigger brokerages. But I definitely think it's a great platform for longer-term focused investors. So if that might be you, you might as well check it out in the description below. It is free to open an account. Anyways, I mentioned value investing as an investing concept, where you take the value of whatever it is you're trying to buy, and then you want to get it at a price below that value ideally, and then you're ideally getting a good deal over the long term, because eventually over the long term it'll reach that value that you think it has, the intrinsic value as it's often called. Now, what you value something at is going to be different for every person because it depends on your assumptions with the underlying business or asset that you're buying, and also your underlying required return. And that's going to determine whether you pay more or less than someone else who might require a greater return or a lesser return on that same asset. And if we take a look at my portfolio, you can see that it is pretty concentrated, which is something that a lot of value investors try to do. They often have a pretty concentrated portfolio because they'll find a bet that they really like a lot. They find a company that's great and they get it at a really good price, and they really focus a lot of their money into that particular investment and then let it run for the long term. That's typically what you see with a lot of the bigger name value investors. And while I wouldn't consider myself extremely concentrated, it's definitely quite concentrated, especially compared to where I was starting with this portfolio when half of it was broad ETFs. Now we can see that over half the portfolio is in these 6 stocks. And within that, half of that is in one stock, or almost half is in Equity Commonwealth. Granted, that's kind of more of a cash pile at the moment. But anyways, I think you get what I'm saying. I am trying to concentrate my portfolio, and it gets increasingly concentrated as I find new opportunities. I sell out of old ones. And if I think I'm getting a really good deal on a stock, on a business, then I'm going to put a lot of money towards that versus leaving it in more broadly diversified funds within the portfolio. Not that I'm getting rid of those entirely. Sometimes I think it makes sense to have plenty of ETFs or broad index funds, and my retirement accounts are filled with those. This being my taxable account outside of my retirement accounts, I'm going to try and create an outsized return compared to the market, at least on a risk-adjusted basis based on my own risk tolerance. Your risk preferences might be very different than my own, so that's why you really have to do the due diligence yourself if you're going to try to do an approach like this. But as many of you may know, my primary identity as an investor is as a real estate investor. I own 3 properties now, and I'm looking for a 4th, and that really is where I'm putting most of my time, energy, and money. I'm putting it towards real estate. Well, I guess most of my time is going towards my job, which is in real estate law, so it's tangentially related. But when it comes to investing, a lot of that time is going towards looking for real estate deals and then putting together projects, putting together teams, and actually coordinating that on the real estate side. And that naturally takes away from stock investing. So why would I try to juggle both rather than just doubling down on one or the other? In this case, probably doubling down on real estate investing, directly investing in properties, not talking about REITs here, although my portfolio does have some REITs in it. Well, the primary reason that I still invest in stocks as a real estate investor is diversification. And I know we were just talking about concentrating your bets on the things that you like a lot and that you think you're getting a great deal on, and that still is is the case, but some diversification is important, at least to me. I want to be able to have multiple sectors of my overarching big portfolio, not just the stock portfolio, but having some real estate, having some stocks, having some alternative assets, maybe some crypto. That's a much smaller portion of my portfolio, but you get what I'm saying. Having multiple different sectors, even if they are decently correlated, but having multiple things to fall back on in case one doesn't perform well, you make a mistake in one, at least you have the other two ideally prop it up. And longer term, I'd want each asset class within my greater portfolio to actually be able to prop up my entire financial life if I wanted to do that. So for example, I'd be able to survive solely on my stock portfolio, on the dividends it throws off, on the capital appreciation it has. I'd want to be able to live just off that if I'd had to do that. I'd want to do the same with just my real estate. If everything else just blew up and all that was left was my real estate, I'd want that to be able to hold me up financially. That's really what I'm getting at when it comes to diversification long term. I'm still a ways away from doing that, of course, but every day I'm inching closer and closer to that goal. But at least as a real estate investor, where there might be some significant lag time between deals where I'm still trying to build up cash and build up the portfolio in general, so there might be a couple months between deals. And during that time, do I just want my cash sitting there, or do I want to invest it in my favorite stocks instead, or even into broad index funds, just to put it to work? And then if I want to take that money back out, rather than having to sell, if we go back here into M1 Finance, I could just borrow against my portfolio. Of course, you have to be very careful doing this, but this is how I bought my last property, or at least how I financed the down payment. I actually used margin on my main account and pulled that out to cover the down payment and then the initial rehab costs. And that way I didn't have to sell any stocks. The margin rate's only 2% right now with the M1 Plus account, which I pay an annual fee for, but that's a really low interest rate, so I don't really have to worry about that. It is variable, so that's what you would have to worry about, at least if you're holding this for a longer period of time where interest rate risk is going to be a much bigger issue. But besides that, I was able to have this liquidity ready to go, to be able to buy the property and have the money ready to go, rather than having to sell off stocks, trigger taxable events. And instead, over the next couple months, as I brought in new money, I could just put it right back into the borrow account, and now my margin's back down to zero. Meanwhile, the money in the account is allowed to continue growing, and I'm constantly building up my nest egg, both in real estate and in the stock market at the same time. And the other reason I still invest in stocks is because, well, it's pretty easy compared to buying a piece of real estate directly, even if you have good systems. It can be pretty laborious getting through the closing process, doing all the due diligence. A lot of the work with buying real estate is upfront, and you got to make sure you do it right. It takes a lot of time and energy, but when you do get it right, it can be very, very lucrative. But anyways, buying stocks comparatively, yes, you want to do your due diligence, but you can kind of do it at your own pace. There's lots of different opportunities out there, and you can start a position with comparatively much less money, so it's a lot easier to just jump into buying a stock. And I also mentioned the liquidity advantage with margin, being able to just take that out instantly, compared to maybe doing a refinance on a rental property that might take a couple weeks at best, even a couple months in an extreme case. It's just a lot slower to access the money that you have in real estate. When you have it in stocks, it's a lot more liquid. You could sell the position if you want to. You could borrow against it with margin, and then if you get a margin call, you'd have to sell your position anyways. But the fact of the matter is, most stocks are a lot more liquid than something like a piece of real estate that you own directly. So really, I don't think stocks or real estate are any better than the other. It really depends on the specific deal that comes for stocks or for real estate. You got to really look at the individual deal, whether it's worth it for you. In my case, I'm going to continue to invest in both because they offer their own distinct advantages. And I think when you put them together, it makes your portfolio that much stronger. But of course, if you don't want to get into stock investing, or if you don't want to get into real estate investing, doing something that you don't like probably isn't very productive either. In my case, I'm interested in both. I like doing both, so I'm going to keep doing both. But in any event, now that my margin is paid off, I plan on putting a lot more money into the stock account, unless of course I find another real estate deal before then, in which case I'll probably pull more margin out to fund the down payment or the rehab or whatever. But I'm going to be putting more money into this account over time in any event. And if you guys don't want to miss those updates, I put out a new video of this series on the 15th of every month, so be sure to subscribe so don't miss those updates. And if you like this video, please like it, since that would help the channel out a lot. And if you want to check out M1 Finance, like I said, there's an affiliate link in the description below. And I also have a tutorial series going over the major features and benefits and the drawbacks of M1 Finance in general. So do check that out if you're still curious. But until next time, take care.